post-crisis pattern of pretty subdued growth globally continued through 2016, but as the year progressed, there were increasing signs that growth was picking up. In the US and UK, employment was strong again, real wages were rising, the UK economy did not implode, quite the reverse post the Brexit referendum, in contrast to the sort of doomsters of the Remain camp. The Chinese economy, with quite a bit of stimulus, both fiscal and credit stimulus, managed to grow at about 6.5%. Even in Japan and Europe, which have been suffering from what's usually called secular stagnation, there were some signs with leading indicators pointing upwards. And importantly, we've seen the trough in the oil industry and the commodities market generally. That was a big dampener on growth. Capital investment was hit very hard in those sectors, and they're big sectors. So I think there's some quite significant changes going on which point towards higher growth in 2017, so a pickup in growth, and with a bit of momentum as we go into this year. On top of that, we've now got the Trump reflation agenda. Question mark how much of his campaign rhetoric will be translated into policy. I suspect quite a bit. This is a man in a hurry. You can see from his appointments that he's making that he intends to implement quite a lot of these campaign policy statements. So I think we can expect to see tax cuts, deregulation coming through, which is good for growth, and some infrastructure spending, which, although it's got a longer lead time, will also help growth. So generally speaking, I think we can now look forward to higher growth levels coming through into 2017. And for the first time since the financial crisis, I think growth is likely to, if anything, exceed on the upside. The change we're seeing in the political landscape and the diminishing effectiveness of ultra-loose monetary policy means that reflation is back on the agenda, not just in the US, but I think increasingly we'll see it back on the agenda in other countries, even in Europe in due course. So I think this period of rising growth is going to result also in rising inflation. And remember too, the impact of falling oil prices and commodity prices is now fading out of the numbers. So inflation, headline inflation, is going to pick up through 2017, and that has implications for what happens to monetary policy. I'm certain that the lows in interest rates in this cycle were seen in 2016, and I think we will see this continuation of rising interest rates, rising bond yields as we go through 2017 with higher growth and rising levels of inflation. We will see the Fed tightening policy. The Fed is talking about 3 rate rises in the course of 2017, and that's quite likely in my view. We will not see interest rate rises in the other big 3 economies, Europe with the ECB, Japan with the Bank of Japan, and the UK with the Bank of England. There's no prospect of rate rises there, but I think there is a prospect that we are seeing the beginning of the end of ultra-loose monetary policy, and this big QE program, the asset purchases that are currently being made by Japan, the ECB and the Bank of England, I think they will taper or end in the course of the next 12 or 18 months. So there is a very big change going on here. Implications for bond markets are that we will see rising yields, continuing the pattern of the last few months. So bond markets still not an attractive place to invest just yet. This environment, I think, is good for risk assets, especially equities. I think corporate profits will benefit from the sort of things we're talking about. It's good for precious metals and commodities, where in a number of cases, most notably oil, supply and demand is coming back into balance in the course of 2017. I don't, though, think we are facing a concern about a return to a boom-bust traditional type of cycle, which would curtail the cycle prematurely. I think we have a long and extended cycle going on here. And the reasons for that are that there are structural headwinds to growth. Notably, demographics are working against growth, falling working age population in a number of big countries. The aging of the population generally is negative for growth. So I think that's an important sort of dampening factor, as is the still very high debt levels that we have globally post the crisis. That also slows down growth. Then, of course, you've got the fact that the dollar has been strong and is likely to remain pretty strong. You've got a tightening of monetary policy in the US, so that also has some dampening effect on growth. So I don't think those factors are enough to curtail growth, but I think it's enough to sort of cap it. So I think what we've got is a sustainable recovery, accelerating a bit, but not pushing inflation too much higher. And so I think we've got a cycle that will run for quite some time yet. I think there are four big risks as we go through 2017. One is the obvious one, policy mistakes. We are entering a new era here, new president in the United States. That's the most obvious area where mistakes could be made, but not the only area by any means. That could disrupt events as we go through 2017. The second, been around a while, China. Will they be successfully able to manage this structural slowdown in growth whilst meeting their politically sort of driven growth needs at a time when debt levels are very high and when they're going through a structural change in the population, with the aging of the population really very meaningful in China. The third, it's a pretty low risk, but further EU sort of disintegration. Remember, the EU has just lost its second largest member, the UK. Populism doesn't stop at Europe's borders. Marine Le Pen is gaining popularity in France. There's an election coming up there in May of this year. So there are some risks around the EU. If we see a further rise of populism, it could potentially damage the euro and the European project. And then finally, you've got this issue of geopolitics. What will the US relationships be with its key partners under a Trump presidency? Big unknown. The Middle East is a quagmire at the moment. Will that spill over into key countries like Turkey and Saudi Arabia? So we mustn't forget these risks, and they are likely to produce bouts of quite intense volatility from time to time as they sort of raise their ugly heads. Notwithstanding those risks, I think the environment is actually encouraging for risk assets generally through the course of 2017. I certainly think equities will outperform bonds and produce reasonable positive returns. It's a good environment for the corporate sector. We particularly like the more economically sensitive regions such as emerging markets and Japan. In fixed income, I think it's likely we're going to see rising yields on government bond markets, so some caution. It's important to stay short duration, to focus on credit rather than interest rate risk, so areas like high yield bonds, emerging market debt, I think will outperform developed world government bonds. It's too early to buy those. There might be opportunities coming along, but let's wait and see. In currencies, the dollar has performed well over the course of 2016, particularly in recent months, and I think it has momentum behind it. The strength of the US economy doing better than elsewhere, the fact that the Fed is raising rates when no other central bank is, are likely to push flows into the dollar. We recognise the dollar has done very well, so from time to time there will be setbacks, but I think generally speaking, with the interest rate differential between the dollar and other currencies as high as it is, then I think we will see the dollar tending to go higher. Sterling has fallen a long way. It's been by far the weakest of the major currencies in the course of this year, hit of course by the Brexit vote. It's discounting to a large extent the worst case outcome to the Brexit negotiations. And whilst it will remain under a cloud while those negotiations go on, I think it's getting to a level where longer term it's becoming pretty attractive, because I think the UK will do well outside the EU eventually. And then the euro, I guess there's a bit of a cloud over the euro given the politics there and this rise of populism, so we need to watch out for that a little bit through the course of this year. Valuations of many of these asset classes have moved up quite a way in the course of 2016, and in some cases are stretched. So I think there are going to be periods of time when markets come under some pressure, and given the valuations being quite high, we could see some periods of sort of quite sharp setbacks in markets, and bear in mind those risks that we talked about earlier. But the general trend, I think, is going to be upwards in equity markets. So I think it's very important through this period to stay invested and capitalize on this very long cycle that's going on. And I think as and when we do get these bouts of weakness, there are going to be good opportunities to add to risk in portfolios. What we'll be watching out for too is yields on US Treasury bonds. If we get a further spike upwards in yields, which we could easily get in the course of next year, that might then become an interesting asset to buy as a sort of defensive component part of portfolios, but too early yet. So we expect the bulk of returns to come from equities this year. Stay invested, be prepared for some bumps on the way, but I think we can look forward to a year when we should achieve at least mid-single digit returns in our multi-asset portfolios.